I have my next guest with us in studio. He is an attorney with Sherman and Howard. Now, let me tell you, he is the guy when it comes to legal matters in apartment syndications and funds. So his practice focuses on matters related to capital markets, securities, finance, real estate, mergers and acquisitions, and corporate and transactional law. So, Tom, welcome in.
Thank you.
Good to be here with you today. And I've got Tanner here, who also is doing syndications. And I thought, Tanner, I would open up with you and just start with, yesterday you showed up. We were talking a lot about the capital stack, cap rates, all the market stuff. But let's start and pull the lens back about how did you begin the apartment syndication process and what started you?
Yeah, so once we decided it was going to be a go, legally we needed to get structured. So Tom was actually, if not my first call, really close.
And that's not always the case, right? I mean, sometimes people don't call the attorney for. I mean, there's fees associated with that, so maybe they're
I haven't found the free one yet, but I'm still hopeful. So basically, just getting your entity set up. So for me, for a syndication, it was, I think I already had the trust set up, but just getting everything in the corrected box, and then sitting down with Tom and his team, and mostly discussing what the path forward was. So basically, who would be the investor? Understanding and getting the correct forms and all of that stuff. So, as you know, there's a lot of disclosures that are needed when you're taking people's money. It's a very serious thing, and so we do Reg D filings, and Tom handles all that stuff for me actually, and has on every single one of my deals. And so it's always a little bit overwhelming of how fast the laws are changing, or how many different tweaks we've had to make. And we always joke that it's going to be really refreshing if we could ever reuse the same PPM, and I don't think we've ever been able to. So
you've been quite creative, though, in some of the deals.
It sounds expensive.
Typical syndicator, right?
Yeah. I'm just still looking for that discount, but he's been the guy that really just kind of steers the ship on that.
Yeah. Well, pay now or pay later. Tom, welcome in.
Thank you.
Nice to have you here. And I noticed you brought a complaint with you. We have some big things to talk about. Where should we begin in the apartment syndication process? What does that first conversation look like with that syndicator that you're having?
Well, I think it's to get their goals and to what they're focusing on for the type of investment. Is it a value add? Is it an income? Is it is it low income housing? I mean, there's all different types of multifamily investments that to focus on. Then to understand where they're planning on getting their capital. Do they have one or two wealthy investors that are going to take the whole project? Are they going to go out to a group and do a more traditional syndication where we would be doing a private placement memorandum and doing kind of a retail syndication to try to raise the capital, and then understand what their business plan is, how they plan on making money. What's the project? Do they have one already picked out? Do they have a business plan put together for it? What are the economics involved? What are their fees? What are their percentage of profits? And then take that and develop the documentation that they would need to go out to do the transaction. And then it's the other aspect of just the capital raise, and the lender financing is another piece of the puzzle that needs to be solved. And is it a traditional Fannie Freddie? Is it a CMO loan, which is Tanner loves those, I know. So they're much more complicated and much more fees and much more restrictions involved than your traditional Freddie and Fannies. But and then I think I might have already said, but you've got to where's the asset? What is the asset? Do you have it already? Are you planning on trying to raise money and then go out and buy something? Are you looking to do one property and or multiple properties? And then so all those kind of questions are kind of the initial mix of things that you would need to know to see where to go with the project or how to steer the project.
Yeah, and Tanner mentioned sort of doing the multiple deals. Not all, they all have their own unique characteristics. Maybe even different investors and different structure, maybe even different loans that bring complexities to the legal environment. He mentioned Tom and team. Tell me a little bit about why the team is important to the depth of what some of these real estate transactions end up being.
Mm-hmm. Well, there's multiple disciplines. There is securities regulation, which is my forte. So that's doing the compliance to do a proper Reg D offering, the disclosures, the filings, and not only with the SEC but with the various states that you have to file your notice documents with. Then there's just the finance part, dealing with the lenders, dealing with the how that's going to be structured, how they're what's the loan documents going to look like, what opinion do you have to give to get the loan, and those type of things. And I work in that area, and I also get help in that area from some of my partners. And then there's the straight buying the real estate, buying the dirt, getting the construction contract. If it's a build, or is it if it's buying an existing apartment complex, that's a separate discipline that takes takes other that I rely on other people in our group to help make those go smoothly.
Yeah, and Tanner, so for example, you get into a deal and it reaches beyond, the complexities of a traditional, talk to me about the relationship that you guys have in, what can a syndicator expect, I guess, in this process?
Yeah, I would say, I tell people that are wanting to get into syndications, if they call, they typically on your first syndication, you don't have any, you're low on funds, money, but this is the one spot, you cannot. You cannot cut. I will see business plans come out where people have literally copied somebody else's disclosure from somebody else's, PPM or business plan, and it has the wrong state on it or whatever. And I don't know if we've had the same disclosure twice because they change all of the time. And, I'm always complaining about it, right? Because it's literally, you're tweaking a word. But it's, it's really important. So I guess I would say is just be prepared. Put that team around you, and if you're lucky, hopefully you can tie it into the deal. But there's no cutting corners here.
Yeah.
So
yeah, I've seen several of business plans that come in, or they've say, oh, I've already drafted the PPM. Just look it over and bless it. And you get things like first they're an LLC, then there's sub S description back in it, and then a partnership. So what they've done is have 4 or 5 samples that they've cut and pasted out of without really an understanding of how any of it fits together. So those deals are, I say, well, I can work on this deal, but it's going to be probably $10,000 more for me to work on your deal and fix it, as opposed to let's start fresh.
Yeah, and so what happens when you're trying to do it on your own and someone, these things can be very problematic, as Tanner said. I know you brought in.
Yeah, well, you said, why do you need an attorney? What I got a couple weeks ago came out, and just the stuff that I get to read all the time about what's going on in the industry. But a complaint filed in California against a syndicator, Matthew Skinner. The SEC has charged him with securities fraud and violation of Broker-Dealer Act from what he did. He was one of the more egregious. He was not only making gross misrepresentations of the deal, how good it was going to be, and all the investment returns, but he was also siphoning money off the side. So that's why the SEC, I think, was interested in him. If you're honest, so he was both dishonest and not capable of giving out bad information. If you're honest but you don't know the information to give, you're still in violation. Will the SEC come after you with a complaint? Maybe not, but there's still another level. There's all the state administrators out there that are much more active in being proactive to protect their citizens from bad investments. And then the third reason that if you're not in compliance with securities laws, you have basically guaranteed the deal to your investors. So if it goes bad, the statute of limitations hasn't ran, which there's a lot of things to keep the statute open for a period of time other than the set 2 or 3 years, depending on the state. So the investor can say, "Gee, this didn't work out. I want my money back because you didn't tell me the right information. You had misleading statements, or you omitted to tell me material information that I needed." So those are really the 3 reasons to go in compliance is the SEC, the state, and your disgruntled investors.
Yeah, and before we, what I'd like to do, and we're good with the complaint. We don't want that. Before we talk, I'd like to talk about even structure, LLCs, and these types of things. But before that, I'd like to give an opportunity. Tell me a little bit about the firm, yourself. Our viewers haven't, engaged with you yet. They don't really have that background. I'd give an opportunity to sort of give some background of who you are, how you think about the business and the firm you work with, and then maybe we can follow up with that with some structure. Sure.
Well, I'm at Sherman Howard. I moved over there about 8 years ago from Lewis and Roca, and where I'd been 15 years prior to that, and doing basically the same practice that I kind of started in when I got out of law school, and we're doing not so much multifamily, but a lot of the syndication work in other. They were more tax shelter oriented back in those days. But I have a tax background and a securities background, and with that, I draw on that to structure the transactions, because they're both intertwined because of how you structure the cash flow, the deal, the flow of funds, and then also how you make it compliant to raise money from the investors. Sherman Howard is about a 220 lawyer firm. The largest original office is Denver. They have other locations in Colorado, offices in Albuquerque, St. Louis, Nevada, and then Arizona. We currently have 2 offices, one up at the Kierland and one downtown. We're combining those as of next March, and we'll be at the 24th and Camelback area, which is right down the street from my house, so I'm looking forward to that. So, yeah, that's nice. Tell me a little bit about who you help, and maybe even more what a typical client looks like for you. Well, some people come in, they're new, but most of the work is repeat clients like Tanner, who's we have done multiple deals over the last 10, 12 years, whatever that we've been working together. So those, those type of clients are repeat. They're out, they're in the business to get a new project and and when they get the project, then we get to work on it. The startups are, they're on occasion, and I like startups, and hopefully they become the repeat customers, clients that do multiple deals. Most of those are, it is an educational learning process of what I need to get the information in order for me to do what I need to do for you. And we have, questionnaires that you fill out. There's all kinds of compliance questions that you need to answer to make sure you're not disqualified from relying on the normal exemptions that we rely on from registering the whatever interest we're selling and under the securities laws. So all of these are targeted to be non-registered to hit the exemption. The exemption is 9 out of 10 times a 506 offering under Reg D, which I can explain that, but I'll just I'll let you ask questions if you have about that. So and then what I are they a wannabe in the industry that are just trying to find out what they need, or do they have a real deal? And then if you have a real deal, then we need to get focused on how you implement that. So sometimes it's the they want to get started. What do I need to do? I can give some guidance in that, but they have to go out and do the work. I don't find real estate or do that type of stuff, or nor do I find capital. I allow them to, or I give the legal advice to how to raise capital, but the client has to raise it, and the lending process. They have to work with their own brokers and what have you to get the deal.
Yeah, I would love to learn what is that question. What are those in that questionnaire? Like, what are those things that a syndicator would need to provide a firm or an attorney like yourself in order for you to get to work? Mm-hmm. And that's also does that help in? It really doesn't reduce the cost of things, but you have to spend time with people, right?
Yeah.
So,
well, I guess there's two different types. One are the bad boy provisions. Do you have a securities violation in your past? Do you have you or other issues? Have you ever been? Has a state administrator ever banned you from selling securities? So all of those are potential disqualifying events to qualify for a Reg D offering. The other type of questionnaires are your background. What's your educational background? Where have you worked before? What are what's your bio in effect, so we can develop the description of what we need to describe about you as the syndicator in the transaction. And then the others are maybe not so much of a questionnaire, but what's your deal look like? What's your do you have a contract ready to go? Do you have an option? When can you when you taking it to escrow? What's our timing to get to meet where you're at in the project? And so that's, I think, the most of the questions.
And they process it afterwards. So, like, after you raise the money, you still have obligations. So, for instance, like blue sky filings, right? So now you have to report to, if you raise out of some states require, and the timing in which the money comes in. So, and that felt like that was not a recent change, but all of a sudden, once you have a window, the clock on your PPM of, hey, first dollar's in, to get to that certain threshold. And when you get it, then you file the blue sky filings to each state notifying that they have an investor in this offering in their state. And so there's just a lot of moving parts that, again, with the syndication part, like you gotta be focused on the deal and raising the money and doing all of the stuff. But the PPM, it protects the investor as much as it protects the developer or the sponsor. So they're big. There are a lot of pages, and I joke sometimes that it's 140 pages to tell somebody all the different ways that someone could lose their money, which would be just a lot more simple and less expensive. Of like, hey, you can lose all of your money. But what Tom and his team do that are really good is they're forcing the what if situation. So it is a lot of questions of what's your plan? We're identifying capital items that we're so if we're raising $1.5 million for a capex and we're going to do windows, or we're going to identify all of that in the PPM, put language around that. Same thing like when it comes time for the lenders with Fannie and Freddie and whatever. If you're going to get those types of loans, obviously a credible firm and a credible attorney that has done it makes that process a lot smoother.
Do you ever, and John has a question here from our viewers, do you ever, when do you engage in the off-market process? I guess it really doesn't really depend on the marketability of the product, but
Tom and I talk all the time.
Yeah.
So it's, what are you working on? So there's always some sort of chase, but the minute I have a signed LOI, that's really when I think, well, I don't know when you start the clock. Maybe the clock's always running, but
the clock can be
usually the LOI.
Yeah. So hey, we have the LOI. The LOI is, that's where we're going to get on the phone. We're going to walk through the deal. I'm usually writing a business plan at that time, right? Of like, hey, here it is. So I'll put together this.
Which is very different from the PPM.
For sure. I mean, the business plan is what's going to go out to the investors, so that might be 15 to 25, pages of the market,
right,
the rents, kind of our thought process of why we're buying that. He will take that. He's involved in that, right, with the disclosures and everything. And then we're fine tuning that. Like, it's not, we do our best that you don't have any, erroneous assumptions, if you will. So, so at the LOI, so really for me, my first call, it goes to Tom. If Tom is going to delegate something on the PSA, or we have a tax matter that came up on a new construction deal, it's called the speculative builder's tax thing. That's not real fun to talk about. So, but it's municipalities and a lot of people, some municipalities haven't dealt with it a lot. And so, Tom's like, hey, I have a partner here. Like, they do a lot of that, shifts it. And so it's, he's my quarterback, if you will, on, I just want to vision up the ideas and the product and whatever and go. And then, he is, protecting everyone around that. So it's, and it's a continuous, process. So you don't just get the money, off you go. Hey, everybody saw this, they signed it. There's lots of documentation along that.
All right, let's see. Do you know any other merger? Let me see here. I got a question here from John. If you do you know any merger and acquisition firms that clients can hire to negotiate with institutional investors? So even at the entity level, I mean, you can purchase real estate, but also companies that also own the real estate. But is that also a process where you're now handling a merger and acquisition?
Yeah, I do merger and acquisition work also. I mean, it's sort of the transactional business attorney. So, like I say, I do the Reg D syndications, I do merger and acquisition, and other corporate stuff as it comes up, all the time. I mean, I have a current acquisition, or actually I'm on the sell side of very typical in Arizona, a ma and pa business did well, and they're now at the age where they want to cash out and go, hang out in places that aren't so hot in the summer as are here, at least during our summers. So and that's it's real estate, it's a farming operation involved, and so I'm in the middle of that, and there are other transactions that are working, or that I work on continually. But just to buy a real estate company or buy a syndicator, I don't typically see that, because they've built it, and if they are going to cash out, they would usually sell out to a REIT or something like that. Would be the more typical exit strategy for that.
Yeah.
And one of the things also that syndicators that I see happen a lot is once you enter the PSA, whether you're the buyer or you're the seller, you have now another attorney introduced, right? So now you have this LOI agreement where everything's, hey, this is our intent, this is great, and then brokers can speak to this a lot. They see it oftentimes.
This is on the other side.
Well, so once you're trying to actually put the deal together on the PSA, elbows come up a little bit, right? So you have an attorney that might be trying to flex over here, right? Maybe we've had experience where it's like a newer firm. Attorney's trying to obviously earn their business, so he's very, very aggressive.
Look what I found.
And they can kill the deal. Like, you can really kill the deal. And so, to compliment Tom, what he does very, very well is works together, right? So if the goal is really to buy or to sell the real estate, there's in both people's interest to do that. And so,
getting the deal done,
meeting in the middle, because the law, they can redline the heck out of it, you know. So, for lack of a better term, the brokers will call it a bloody contract, because it just comes back redlined so much, and it's you're tweaking really a word that has no material effect whatsoever, or it can become a mess. And so as syndicators pick their team, that's I didn't have to coach Tom on that, but if they have somebody that's maybe the newer attorney that's getting into syndications, or says, hey, I can handle the syndication, that you really got to sometimes just get everybody on the phone and say, what's your intent? Right? Like, are you this language, we're interpreting it it seems very aggressive. What's your intent? And oftentimes that will diffuse and then progress things moving forward. But he does
the communication with the other side. I mean, as Tanner said, we're all looking for a win-win on if he's got a property he wants to sell because it's the right time, it's where it is, and the buyer has a property that they want to acquire because they want to operate the property and go forward and do as well as as Tanner's done. And then on the other side, we've got if we're on the buy side, we're have a seller that wants to cash in, and so we try to certainly come to the middle of anything, but just good communication with the other side, having an all hands call just to say, what's your intent here? This, as Tanner said, this looks a little aggressive. Can we try to meet your intent by, if we understand it better, by something that's not as offensive to our side?
And you can mitigate the cost a little bit, right? These emails that go back and forth with the documents, it goes back for just time, right?
Yeah,
I mean, it's just the clock's ticking on both sides.
No, it's. I always prefer to pick up the phone and hey, let's try to have a 5-10 minute call to see if we can iron this out, as opposed to a 10-minute email to they respond to another 10-15 minutes, and then we've escalated.
Lost in translation. All that.
Yeah.
And for the purpose of what we're doing here in the program, we're at the top of our show, we did the educational disclosure like this. We're not giving legal advice. This is not tax advice. We're not investment advice. Like, this is only for educational purposes. What, before we get into all of that, I want to talk about, what should the structure be? And I know it depends on the deal and what you're working on. If you're buying a portfolio or a condo, a condo and you're trying to, turning into an apartment, whatever the thing is, it's deal specific. But typically, what are you seeing in structures? What's most favorable for these outcomes?
Well, it's a flow-through entity that in our current tax structure, so you don't have an entity that's taxed and then you're taxed on the distribution. So, and those can come in the form of a partnership, limited partnership, LLC, or sub-S corporation. Sub-S corporation is not very efficient for real estate because you can't do promoted interests. It's one share it is all treated the same, and you can't have two classes of shares. So that leaves the LLCs and the limited partnerships because, again, you want protection from liability for the investor. So you looked at those two entities. The easier one to use is an LLC. You don't have to have a separate entity that's the general partner. I mean, you typically have it as a manager, but the partnership structure, the general partner has to have a percentage of the deal, and it can be a very small percent, but that means they have to put capital in and do all the things that just heads up with the investor. With an LLC, you can avoid that. You can have a manager operator that has zero interest as a manager and operator, and it all goes. It's divided up as an investor, and a lot of syndicators will put money in with the investment, and I think Tanner almost always does that, and just to show, I'm right here with you investors, and that, but. So if there's not a reason to use a limited partnership, then we typically go with a limited liability company. The reasons that you might need a limited partnership are if you're getting foreign investors, particularly Canadian investors. Canadian tax system doesn't recognize the LLC as a flow-through entity, and so then you have to structure it as a limited partner, which they do recognize, and in order to get the favorable tax benefits of the flow through up to the Canadian investor, and when the profits come back to them and they're taxed under the Canadian authorities.
And one thing I would say is on our deals, so we set up an entity. So we set up typically where there's always two entities. So we have a general partner entity, which is
or manager.
Then we have the other entity, and that's where the general partner and the limited partners meet, and that's who's buying the property.
Right.
And the investors, when they write the checks or wire their checks, the money's going to that entity, that bank account, right? So I've seen some syndications before where, it's just another checkbox, right? Like if you're an investor, or you go and you're getting your EIN, you're setting up the entities, setting up the bank account, and then all of those funds flow to that account. So nobody's ever writing Tanner a check, for the syndication. Yeah. You're buying
LLC
except Apartments LLC.
Yeah.
Yeah.
And then there's another LLC that passes.
Yeah, that's so
the management entity. Yeah.
Yeah, so not to get in the weeds, but like I have the Tanbic entity. We'll set up a GP entity for each property. Then we'll set up the property, LLC
The owner. Yeah.
And and it all flows through there.
And does the GP entity, can it participate in multiple property entities, or is that the way?
If we 1031
each
What do you mean participate?
Well, I guess the GP entity, if you had multiple properties.
Yeah, so
each property you're having a GP entity, and okay.
Yeah, you typically have one property per entity, and even if you have a fund, you would have where the money would come in and be the owner. You would have an entity, an LLC that's wholly owned by the parent fund to to hold the property. That way you protect each property stands on its own for liability purposes. If there's some calamity, it will not bring down your other properties.
Mm-hmm. Yeah. So let's talk a little bit about, maybe even Tanner, you can speak to this even more, the mistakes that people are making now. We don't have to name people or companies, but like what are some things you mentioned earlier about rushing into the process, maybe even doing a business plan, assuming that that's the PPM, but talking to capital too early. What would be some mistakes that people are making now that investors that are watching can either avoid?
I just don't see a lot of the appropriate disclosures on some of the solicitations that are coming, or as we've talked about, the syndicator of the syndicator. Or people are they've syndicated a deal and then they're going out to another syndication or syndicator to help raise funds. And so, if you'll look at, now they've done that and they're raising it, but perhaps maybe their PPM doesn't reflect, that. It's one of those things. It's expensive. There's no way around it. It's one of the biggest expenses, but it's so important. And if it feels not expensive, then I would challenge that maybe perhaps, it's not.
And you have the confidence too, right? Like now that you were talking about the development deals and slopes and figuring all these things, like this is not something you want to carry on in your own head.
I feel like the rules change like every 2 weeks. It's
the law changes and then the deal structure changes because you have different, if you're buying property to build, that's different than if you're buying an asset that's already built. Is the asset, maybe it's an old low-income housing project, which has a lot of extra issues or maybe that particular property has some zoning issues, some just other issues that crop up. What I see, though, back to your question of what I see failing or what to avoid is I think if the not or being too optimistic and trying to draw, get too, have your projections look like you're going to have a very great return, not which you haven't counted all of your costs, potential delays. You don't have proper contingencies built in of money contingency just to cover things that come up. Trying to learn how to do it on the fly or build the plane as you're flying it is what I would say where I see the problems that come up. And you get into it. You're doing a remodel of the large project, and you've spent your budget and you're 2/3 the way done, and that then you don't meet your projections because you can't rent the unrefurbished apartments out for the same, or it just causes a spiral down on those projects.
I've seen business plans where the words guaranteed used, right? It's 7% guaranteed.
Right.
But like they're there, and so and we'll joke sometimes that whatever range you put for the investor, they only see
the top
of the
right?
range,
So it's 6 to 10. No, it's 10, right?
Yeah.
So, and sometimes it's frustrating because we'll go through the PPM and he wants like every single detail, like okay, the square footage, you're going to raise it this, you're going to input this, what's your timing, and you just but he's basically backing up the theory and the claim of what you're saying, if that's
And these are these money contingencies, even disruption to the ability to execute or pull off the game plan of repositioning.
Yeah, and it's you're optimistic about costs and about timing, I think, are the two main.
And so, Tanner, let me bring this to you on, those are some great great questions to be thinking about as you're part of that even disclosure. I mean, if you could answer those things, you're just a better operator, right? I mean, it's this process. We call it expensive, but really it's not in comparison to like the cost of not having this together, right? Like we showed that complaint. That's going to be quite more expensive, right? To defend something or to deal with the frustration or the impact to the emotional impact to going into the next deal when you're dealing with a compliance issue, you know, the hesitations that come with that, or ability to raise capital, right? So knowing all that, if somebody isn't ready and doesn't have those plans in place, they are just getting started. Is this like a co-sponsor thing where they team up with someone with that strength that can kind of bring them along that process? Do you see those scenarios?
Yeah, I mean, I think whoever the syndicator is should just go get their entity set up right now, whether it's their LLC or their S corp or whatever they're going to do, have that, and then once they find the deal, then they can, you know, then they can get into all of this. And and quite frankly, if the deal can't support, you know, this, then perhaps you shouldn't be doing, you know, the deal. Now, the problem is you can go down the path, and we've had a few of them where you're negotiating PSAs or whatever, and the deal doesn't come around, but the bill still comes.
Sure.
Right. So then, you know, that's just part of it. So as people are capitalizing themselves to go into business, you know, I think people need to allocate for some legal fees that you might be in front of your skis on a little bit.
Yeah, yeah.
And some maybe have a great ability to find a project, and that's a good target to go after, but have not as great ability to do the capital raise and the financing. And those, you know, are people who perhaps could partner with more, you know, if experienced people in the you know, in the industry. I know that's.
Yeah, so like a strong, and one of the questions asked here was like a strong operator, manager, and do you ever see them where there's options where they can either buy out into the syndication, or there's, you know, they could either earn in or buy out into a syndication?
Usually a syndication is just those type would be just a one property. So usually the exit is you know, just to sell. I mean, you would have your you split up the promoted interest, and if you know are doing a joint venture with another person in the industry, so that's a matter of negotiation and what you bring to the table. And if you have a property lined up that's a great and you're weak on the capital raising, then you know, then that's you sit down and figure out, okay, here's if there's a 20% promoted interest, how's that 20% divided up among who's contributing what to make the whole deal go together? Because it is there's you know, I was say it's like a stool. There's three legs, and if you don't have one of the legs, it's not going to stand up. And that's the property, the financing, and then the equity capital. And if you don't have those three, you don't have a deal.
Yeah. What happens oftentimes too is, you know, a syndicator is going to go out and they're just beginning. Oftentimes their capital is literally friends and family, you know, the first capital, which then you would argue there's that component of people might be investing because, one, they're trying to support you, or there's a level of trust. It's less about the deal. And then as you start progressing and you start getting new investors and putting this around, what these documents do is it provides a level of credibility. So if you're going after high net worth, like, this is going to be expected, especially, again, as you grow. It's a must.
Yeah. And Ross asked a question here, you know, clarity around the GP and LP structure. And maybe this is more towards funds, which I would like to talk about next, syndication versus funds. But having a registered investment advisor, is that required to start talking to money at the syndication level? Or is that more towards the fund collecting that asset management fee?
Yeah, no, it's not required if you are only doing a limited number of deals per year. So if you are the rule of thumb is 3 to 4 a year. Arizona statutorily allows 4 deals before you're considered to be an investment advisor that would have to register to sell, or a broker dealer. Or if you're doing more than those, then you engage a broker dealer, or you create your own broker dealer, and that. But you're getting up into the realm of you're doing a lot of volume to get to that. Mm-hmm. So, do you need somebody to find capital for you? That may be an offshoot of that question. Then if you do, then a broker dealer would be somebody who would probably charge 8 to 12 points of what they raise, and so if your deal can withstand that that cost, then that's great. Use those people because they can access capital. But if you're like most syndicators that I work with, they have their investor pool. They have their reputation and are able to go to the people that they already have a pre-existing relationship with and raise capital. I don't know if you want to get into is this a good segue into crowdfunding, but I could talk a little bit about that. The other way to raise capital is with what's become popular in the last 5 or so years is crowdfunding, and the rules, SEC rules changed where you could do it would still be considered a private placement but you could use whatever media, internet. The guy out at the corner with his sandwich board, advertising, whatever. Those that I've seen have there were a lot of activity early. They would raise capital. So the sponsor would come in typically with his deal. He would have a presentation to the investors that was through the platform the crowd raising platform, and raise capital in that fashion. They would take less fees than a typical broker dealer, but what I've also seen is they weren't as good at vetting deals, and I've seen there's been some of the those platforms that have failed because of they just had bad deals that came along. But that's certainly a method that's out there. It's I don't think it's a panacea to somebody starting up. That it's I'm going to put my webpage on the internet and I'm going to get all this capital coming in. But there's that is a new option, but along with costs, additional costs that you have to pay for the platform, and also there's additional securities regulation compliance matters that you have to deal with to do those type of offerings.
Mm-hmm. Very interesting. What do we need to be thinking about the difference between like the fund or the syndication? Can we talk a little bit about that?
Well, and define it as a syndication is a one property, typical 1 or 2 specific properties that you're going after. The fund is where you're raising money in order to have into the future to find projects and properties and close on them. So that's our working definition. You have to walk before you can run, is what I would say. So if you really, it would be very odd for somebody to say, I'm going to do a fund because I'm going to raise $100 million and have that ready to go to start buying properties if you haven't bought one property before and know how to do it. You also wouldn't have very much of to put in your private placement memorandum about your track record, about your organization, and all of those things that are looked at for by an investor. So the funds are more for people who have been in the business, had success, and are ready to ramp up, I guess, if you will, to get a more steady capital flow behind them.
Yeah, we were joking yesterday about the expectations and all the cash buyers. You raise the money, you have the fund, and then the expectation is to go out and buy deals, even all cash. And even then, you're still not, you're competing on all different elements.
Right.
So in terms of that track record you mentioned on the fund, I mean, not run before you or walk before you run, and are you seeing where you have operators that have track record implementing, operating for institutional even operators, but haven't been principal to a transaction, or even they haven't financed or guaranteed their own loan or anything like that? Are you seeing that there's a trend where they're kind of getting the 15 years experience operating, getting into the business, and then going out on their own and starting up something? Are they able to leverage that track record as part of track record, even though they weren't on LLCs? And
Sure. Yeah. I mean, that's
expertise more.
That's part of their bio of what they've done. So yes, that's definitely part of it. But the track record that you disclose in the PPM is what has this syndicator, for example, what has Tanbic done? What are their properties? How have those done? But having the background,
more of a knowledge.
In the industry, right, and or that you were had X successful projects as you were working for XYZ firm buying, and that's all good. Sure. Good information, but it's that's and if you don't have that kind of a background, it's going to be your likelihood of success, I'd say, is not great. Yeah.
Be the LP. Yeah. Are you seeing LP investors that are investing and then ultimately trying to then become the syndicator, or that's their way of education in? I mean, they create wealth some other way, and then.
Yeah, I mean, I definitely have had investors that have come in and participated in a couple deals, and then have gone out and put a deal together. Mm-hmm. So, yeah, I mean, that's I think that's common. I mean, I invest as an LP in other people's deals, so it's I do find it interesting sometimes, on their business plans or projections or whatever. But there's a lot of opportunity out there, and a lot of groups have, it's mostly comes down to timing for me. Yeah. So,
where do you get your information, like other than Google and that obvious stuff? I mean, it all starts there, right? But I mean, what are the indicators that you track to put you in a position to not only enhance your ability to be a great sponsor?
Well, I mean, the operating company, the management company provides real-time data daily, right? So that's a huge advantage to when people get to the point where they're an in-house operator, is, you're seeing the rents, you're seeing the collections, you're seeing, firsthand experience. And there's not typically a long delay with a third party. It's just here, and I can access it anytime I want and dissect it. So get lots of information there. The market, you can just follow the large publicly traded REITs. Like, they'll tell you in their quarterly reports. In fact, I've invested in a lot of them because I enjoy getting their information and their performance. And so they set certain benchmarks, but again, I'm always really interested in where the large capital is going, and right now, as you've been hearing, is they're all trying to get into Phoenix. Phoenix is very, very difficult to buy. This morning had another partner who's a syndicator, and he's like, "Hey, do you want to sell X property?" And the joke and the banter was, well, where do you go? There's still upside. You know, it's the same thing people are talking about with their house. I could sell my house, I would make X. That'd be amazing. But really, unless you're willing to go to a different market, there's no gain to be had. So yeah, it's just there's a lot of guys doing deals in town, and you know, everybody continues to get surprised. Well, I know we're going to get surprised about some of the price per pounds and some of the records where guys are just going to pull the trigger, as even, you know, John alluded that, you know quickly like who the players are in the group, like meaning you have to go, you're just going to break a record probably right now to buy really anything. Yeah,
very good. Tom, we're coming up on the end of our time here. Any final thoughts you want to leave our viewers with?
I'm better responding to questions.
Yes.
But no, I think this has been a good discussion and hit on some of the highlights of how to, you know, think about to get started in the process. I think one thing that I didn't chime in on that I would bring back was I do think a well-drafted set of documents is a value add to the syndicator. I think you get into sophisticated investors, and if they see something like I was talking about, where there was talking about an S corporation and then an LLC and then something from, you know, the state of Delaware and something from the state of Nevada, that those deals probably won't get a second, you know, even a full read through. Those will be not, you know, cast aside. So I do think it's if you do have good underlying documents, good business plan, well thought out, I think you are well ahead of at least you get in the line to be looked at. Otherwise, I don't even think you qualify to get in the line.
Yeah, it seems like an early indicator or red flag. I mean, you can't do the small things, you're not going to do the big things. Not that it's a small thing, it's actually a big thing, but it'd be very interesting to, you know, set yourself up in a way like you are structured and organized in such a way that those that want to be involved in great things, that has to be true for those to be present. Early yesterday morning, top of the show, we launched our Mastermind. The whole idea here is not to give advice or, again, back to this is not investment advice, tax advice, any of that stuff. It's just extract the knowledge. Like, you're working with people that are winning at the highest level, and you're helping them go faster and keeping in tune to, like you mentioned, the changing conditions or the new laws that change and all that kind of stuff. And so that's exciting. However, for our earlier show, we had Steve Laterra on talking about a new program around building, basically build to rent single family homes. And if people get out and do things and it represents the industry in an unfavorable way, it's not good for everybody. And so it's good to sort of extract your knowledge, if it's on our platform or wherever it ends up, so that others can start doing the right things in the right orders with the right people. And that's been a goal of ours, and we appreciate you taking the time for that. And maybe even we can convince them at some point to come into the Mastermind. And you were talking after the show yesterday, we were talking about, like, let's bring them in and actually not do it for them, but like bring the team together to get people over the hurdles. Because when I was running 1.2 billion in real estate, literally being on the asset management side, I mean, you have an investment committee, you have a team there, attorneys, the lenders, every CFOs, operators, the marketing, broker dealers, everybody that's a team sport, right? So in order to have all that go well, I could kill a deal, just one person with this team, because it all, attorney could kill the deal. You may be, and so as I think about that and the need to really truly help give people the team, without the team, you've kind of built a company around that where you have like this.
I have a huge team, yeah.
Huge team, yeah. But you're also
have a small office.
A modern company, right? Like we were talking about, like 250 square feet for every employee, like you're totally disrupting that whole model. And one phone call, you've got, 250 attorneys at your disposal. So I think that I'm excited about that.
We try
Mastermind.
not to use the litigator, so that cuts more than half.
Not them, yeah. So
Every now
having
and then, though, you have to. So.
you got to send a message. But the point is, it's not something you can do on your own, right?
That's correct.
And so tell me, 2 minutes or less or whatever time, tell me, what are your final thoughts, Tanner, on what makes a good apartment sponsor or syndicator?
Yeah, just be a good steward of people's money. I mean, people are giving you their money with the intent that you're going to do and say what you're going to say and do. So one, just do that. But also, if you decide you're going to take people's money, because once you take somebody's money, and the syndicators that have done that, everything changes about that relationship immediately, right? Whether it goes good, bad, indifferent, the relationship changes, especially if it becomes, sometimes I'll hear syndicators say, well, I don't need a PPM because it's just my friends and family. And I would probably argue you probably need it a little bit more, because you owe that to them. So just don't cut corners. Yeah. And I know it sounds silly, but do the right thing. So investors understand market risk, right? But you're going to have a harder time trying to explain negligence on something. So it's just it's not impossible. There's guys like Tom. There's his team. CPAs, market. That's what I did. Is I went out and said, hey, when I was starting, I don't have the infrastructure to bring all this in house. And I think when I first started the company, that's where I initially would have, that would have been the vision. Now I wouldn't change it. So, it's, like you said, we have access here, we have access there. Those relationships, I'm extremely loyal and they're extremely important to me. And, I think they were loyal to me in return, and it's been a really good model.
Yeah, that says a lot. Appreciate both of you coming in, sharing your time. I know it's very valuable, and hopefully we can have you back on for some more work we do.
Well, enjoyed it, yes.
Yeah, awesome. All right.